Hi, I'm Kris Moe. I'm with Horizon M&A, and we're a Bay Area firm, and I happen to live in Marin. I'm a Marin Builders Association member. I'm also a Solar Storage Association member, and I'm also a member of the California CPA Association as well. What's that mean? It just means I know a lot of people, and it's in this business when you know people as a connector, whether it's for a buyer or an advisor, it's going to really benefit, and that's everybody involved. So let me share my screen, and we'll kind of get right into this. Um, I'm actually this presentation's about unlocking hidden value in your business and kind of going through some of the myths of valuation. You know, you run your business and you're really good at that, but most people don't unless they sell or buy businesses quite often. They don't really have much of an idea of what their business is worth. So I'm going to go through some of those myths now. You can always reach me at 707-529-6458. You can email me at Kris at Horizon MAA. And happy to get on a call with you to fill in some of the color for this or have just a confidential conversation about your business and an exit down the road or imminently. I'm happy to weigh in. So here are some of the common myths. The multiple, someone might have told you, oh yeah, your business might be worth four times. Well, four times what? So typically buyers are looking at EBITDA, which is just a way of saying that it's essentially your profit, what you pay yourself, um, certain add-ons, which we can go into a little bit more detail, minus what it's going to cost to put in somebody to replace the key person in the business, usually the seller. And it's going to range somewhere between 100,000 to a half a million. If you're running a good size operation to fair market value to replace somebody running a $80 million business is different than replacing somebody that's running a half a million dollar business. So EBITDA, earnings before interest, hello, taxes, depreciation, and amortization. Smaller businesses, we do SDE, seller's discretionary earnings. But for this purpose, I'm talking to mostly trades businesses, roofing, HVAC, electrical, solar, paving, landscaping. All of those are the businesses that I'm focusing on. But even if you're not in those businesses, a lot of what you're going to hear in this is going to benefit you as well. Each industry does have its own little ranges of what a business is worth, and that's what we'll get into. But there's no clear cut, here's what your business is worth. There's going to be a range. And hopefully, in this short webinar, hope to do this in 15 minutes. In 15 minutes, you're going to learn why some businesses are on the lower end of that valuation range and some are at the higher end of that valuation range. So um, basically, you could have two businesses, same revenues. Let's say they're doing 10 million in revenues and they have 1.5 million dollars in EBITDA. So roughly 15%. Um, Here would be an example of why each one can have a different value. One can be growing steadily. The other one might be going the other way. One might have the owner super involved in the business, and the other one might have a really strong management team. Buyers love that. They love to be able to put their key in the lock and get the business, and it can run itself. Sure, they can maybe tweak it, but going back to the first one, if the seller has his hands or in everything or well wears all the hats, that's hard to replace. It's fairly common. And so as an advisor, I'm trying to get my business owners to see that, see their business more from the eyes of a possible buyer. Okay. So there are many other examples. Another one might be your team. One might have a team that's super experienced, lots of licenses, super happy. The other team might be running long on the tooth, or there's litigation happening. There's all kinds of things to bring down the value. I can literally come up with lots of examples. Uh, it's part of the fun part of my job. I get to talk to business owners. I get to talk to business buyers to hear the stories that are out there. There's no perfect deal, but the earlier you find that your baby isn't the most beautiful, you can start working on doing things to make it more attractive to buyers. And aside from your profitability, it might be things as maybe your business has incredible systems, automations, you're using the latest in customer, relationship management. You're using the latest in accounting. You have a great accounting firm. Your books are amazing. That's some of the other things that are going to make a business more valuable. And it really, when I say more valuable, um, let's say you have, let's call this an electrical contracting business. And let's go back to $10 million again, which is a decent sized contracting business. And let's just use the same example of 1.5 million in EBITDA. So some of the things that will help it, I will give that business right off the top of my head without really seeing anything, probably a range of about 3 times to maybe about 5 times, 3 to 5 times that $1.5 million EBITDA. So that's going to go from 4.5 million on the lower side to, I've already forgotten, 5 to 7.5 million. That's $3 million range. So if you're able to start doing things, and let's say you're on that lower range right now, you might be able to add $1 million to your exit. And so an advisor like us is going to help give you some of that advisement. Hey, Kris, I'd love to get a valuation on my business. Now, I have a charge for that. Um, but what you're going to get with that, aside from, that valuation range, is you're going to start seeing where your business is stacking up. Wow, I'm an A here, I'm a A minus here, but I'm a C minus over here. Well, if you fix those C minuses, and that might be any of the things I've talked about so far. Maybe you have spotty books. Maybe you're not growing steadily. Then if you fix those things, you're going to be able to bring up your valuation. And so then you make a decision if it's worthwhile or not. But I think it is if you can fix that in a year and make another $1 million and no profit. This is another myth. Again, let's say you're doing $1 million in recurring revenue. Now, in trade businesses, I don't see recurring revenue happening in a lot of other businesses. You're not a monthly subscription. Now, I see some of the local companies here. For instance, one of the companies doing our plumbing reaches out to me and says, "Hey, we'll do a water heater flush, and we're going to charge you $199 to come by and have a look at that." Um, the same company has a $99, "Hey, we'll come in and we're going to look at your electrical your system." Those little recurring things. whatever your business is, roofers, whatever. Hey, we're going to come in and we're going to do a monthly, an annual charge of $299. Investors like that. Frankly, for trades, it's not as common. But let's just say um, profit can be the difference being, let's say your one company's profit margin, EBITDA wise. I use the example of 10 million top line, 1.5 million in EBITDA percentage. We'll call that 15%. Let's say another company had the same um, the same numbers, but let's say their numbers are dropping. It used to be $2 million on the same revenue, but it's dropping down. Why are the margins going down? It's kind of a mini red flag. Flip that around. The other company is getting more efficient, and now their profit margins have gone from 1 million to 1.5 million. Simple example, but you start to see when you're comparing apples to apples that sometimes this apple over here is a little shinier. And maybe it's a little whatever. It's going to be more attractive to the buyer is the point. So when we look at these different things in your business, you can always, most of the time at least, spruce it up a little bit. Um, Sweat equity. Uh, when you have a business and you're ready to sell, of, of course this happens when you're doing a webinar. Um, they, the story is always important. There is emotions involved, especially if it's a smaller business. You're going to have a buyer that it might be their first purchase. I'm quite often on the size of the business we've been talking about to this point and larger, you're dealing with professional buyers. I'm talking to private equity companies, and they are looking at 5 to literally 100 businesses a week, and they are a machine at doing this. So they're not going to be as interested in the story of what the founders sacrificed. And still, all of you who've run businesses, I know there's incredible stories, um, but don't expect that to transfer to the value of your business. They hope that your sacrifice has created a machine that is going to continue being predictably making money for them. And that's what you're selling. The easier it is for them to say, wow, we got this incredible backlog and pipeline for 2 or 3 years. This is a great opportunity. That's what you want to be building. That's what's very sellable. And you have a very happy team working to support that. What actually drives business? We're going to take out the 5 minutes. Um, the real factors that buyers consider are going to be, let's take that same business, 10 million and $1.5 million EBITDA. Well, one business is flat, and they've kind of maxed out on what they're able to do for whatever reason. This other company might be adding another service. This other company is looking to expand into a neighboring geography. That would be so growth, or all of a sudden, if your forecasts are showing a big jump in profits for whatever reason, that's going to bring up the value of the company, even though at this moment in time, two companies have the same numbers, top line and bottom line, but one is forecasting and can support what the next 3 years are going to be. That's a big deal. That's going to add value. Is that upside? You know, consistency is beautiful, but consistency plus growth is even more attractive, obviously. And you'll be able to charge more for that. Okay. The power of recurring revenue, we've kind of already talked about that. And that is in the trades, it's not quite as simple as many other businesses. Um, but if you can find a way of getting your customers to pay a monthly or annual fee for what you do, then that's going to have a bit more value. I think this one is a little bit more important. I would say in diversification, as in who's your client base? Is it a nice mix where if, for whatever the economy, um, uh, if you're too locked in with, 50% of you, 50% of your business is coming from one customer, whether it's a property manager or whether it's a city government or whether it's, just one big client. When that big client happens to go away for whatever reason, that's a risk. You have to anticipate what are the risks for the buyers. Uh, the buyers like predictability and they are scared silly of risk. So you have to somehow find a way of mitigating that risk on whatever the heck it is. And it might be tied into externalities like interest rates or vendors aren't able to get their products. Let's face it, who likes tariffs right now? Tariffs jack up the price on everybody, and people. That's a risk, not the fault of the business owner, but it might dampen the next year or 2 years. So diversification is important for your vendors, your customers. You want it to be spread out so there's just less risk if one of those pieces go away. And I think you understand that. I love this one. Uh, uh, your team is super important and a big part of the valuation. I'm talking to buyers literally for hours a day. And that's one of the things that always comes up is definitely customer concentration. But hey, is there somebody in the number two position? Do you have players on the bench that can step in when the owner segues out of the business? So look seriously at that. Um, it's really hard to bring in somebody to fill your shoes. Even if they're 6 months into it, 3 months into it, you have somebody with that I'd say aptitude, bring it on because it's going to really pay off for you when you're ready to sell your business. Sure, some buyers, um, frankly, quite a few of them, they have a portfolio of companies that are like yours in a certain sector. I don't care if it's electrical or roofing. Um, and so they might be able to mix and match players from companies, but teams really don't like shaking up the leadership too much. You have built this amazing company with your chemistry. You've put this together. It's a very smooth operating machine. And when you mix things up, uncertainty kind of creates anxiety, and nobody likes that. So, um, oh, here's another good one. Establishing competitive advantage. Um, what's your secret sauce? Sure, you have great books. That's a good one. But what's going to set you apart? What do you do that your competitors aren't quite as good at or aren't as good at all as what you're doing? So find a way of creating something that makes you special, that stands out, that is going to give you this moat. That's what we call it in M&A is you're going to be able to defend your business or your castle with this moat of alligators or sharks or whatever. But it's gives you a lot more value. Um, Absolutely. I think you get that. It's very important. Scalability. I've already mentioned clean financials, how important that is. We quite often try to get our clients on the seller side to do a quality of earnings, and that's a third-party accounting firm will look at your books like they're buyers. They're going to do their best to do the generally accepted accounting practices or GAAP to to just make it clean as possibly can be, because that's where a lot of deals hit rough waters and slow down the process or even discount the business because things weren't reported accurately. Okay. Um, this is a big one, scalability. The scalability, um, it's kind of the importance of having a really good bench or nice org structure is being able to lose somebody and not really miss a beat. Having a team where you'll be able to almost act as a platform. You become maybe the model or the key business that the investor can literally build on. They're going to stack on top of you, or your company easily stacks on what they have. So it's scalability, but it's also, I'd say, nimbleness, flexibility, and this is all, part of the culture of, a good business is being able to handle challenges and have a growth mindset and all these things. So that's really important too. Um, there's two different kinds of buyers. Let's say you are in, um, again, let's use electrical contracting. A strategic buyer is somebody, they're a larger electrical contracting firm. Um, they're competitors or industry players. You don't have to explain the business to them. We love those kind of buyers. They look at your business, and if they really want you, they'll pay a premium for you. They see the value of your geographical area, they see the value of your team, and they will quite often pay a premium for what you have. Financial buyers are typically more analytical. They're looking at math, and they are going to really scrutinize the books. These guys are quite often private equity companies. They're buying your company and holding for 3, 4, 5 years. They're gonna buy and flip. So if they buy your business to say 5x your EBITDA, let's use that 5x times 1.5 million. They just bought your business for 7.5 million, but they are looking at your business to put into a bucket of other companies. And let's say there's 5 other companies in that bucket. And if each company is worth 7.5 million, now that bucket is, quick math, is going to be close to $38 million. Now, when you start getting up to $38 million in value, or take the same example of 5x the EBITDA times another five. Your EBITDA is starting to get up there to a large enough amount where that exit for the private equity company might be 7 times. I was just on the phone with a guy who's buying a large contracting company that's doing $10 million EBITDA, and they're going to pay 12x for it. That's a lot, 12x. So every company they're buying in that space, let's say they're buying it at a 5x, they're gonna sell to a larger fish for maybe those numbers. When you start getting into the hundreds of millions of dollars or billions of dollars in revenues, or 50 plus million in EBITDA, that's the game they're playing. That's what you're getting into. The bigger the company you get, the bigger the multiples go. That's where you want to go. That's why maybe you shouldn't be selling your company. You might be looking to add another piece, add another similar company, or an adjacent service company to help you get to 4 to 5 million EBITDA. Now all of a sudden you might be worth 7x rather than 4x or 5x. So that's kind of the game of a value of valuations. So I hope, so far I'll just kind of summarize. You're maximizing your business value. We've covered quite a few good points here. Obviously quality, your systems, how sustainable is it? Transfer of ability. Uh, these are all things that we can chat more about. Be very happy to field a call from you if you'd like to hear more about these. I appreciate you watching. And if I can help you um, in the process of selling your business or acquiring another business, love to chat with you. Thanks for your time.